Yeah. Good afternoon, everybody, and welcome to the final speech of our conference here at Freiburg, at the conference jointly organized by the Foundation of Money and Currency and the Walter Eucken Institute. And it's my pleasure to introduce Bill to you all. Yu is currently the Chief Economist of the Bank of England. Not a full year yet. He started in September 2021. Yu has an outstanding career. He started with a bachelor's degree at the famous PPE program at the University of Oxford. Then moved to the US and finished his PhD at Stanford University. And then he had, an interesting back and forth between Harvard University on the one side and the ECB on the other side in different positions. He went over the Atlantic from time to time. But then at a certain point in time, he thought it would be better to go to Goldman Sachs as the chief European economist from 2011 until 2018. He was there. Moved again back to Harvard from 2019 to 21. And meanwhile, now he is at the Bank of England. So welcome, you, and it's a great honor, a great pleasure for us that you are addressing this conference with the title of the talk, What Did the Monetarists Ever Do for Us? So we're very much looking forward to your talk. Thank you.
So thank you very much, and thank all of you for showing the endurance and perseverance to stay till the end of the conference on Friday afternoon. I should first of all thank very much the organizers of the conference and the two foundations that have sponsored the conference for their invitation to come, for the excellent few days we've had here together, and also for the great hospitality I've enjoyed. I was planning on starting my presentation by saying, and now for something completely different. And that's partly because after some excellent academic presentations, especially in the course of today, I am going to go back a little bit towards a more policy-oriented discussion. At the same time, and this is a bit addressed to those people watching from afar, I'm certainly not intending to make any kind of conjunctural policy remarks. I'm really going to focus on some broader conceptual and framework issues about how we think about some of the challenges thrown up that have been at the heart of the discussion here over the last few days. I mean, those of you who follow British comedy will also know a little bit the allusion to which this title is intended to get. It has a Python-esque background, right, which is the catchphrase now for something completely different. I thought Monty Python was very popular here in Germany, but maybe less popular than I expected. When I said I was going to do something Python-esque, I realized there's probably a whole new generation of economists who think that's something to do with coding languages to do econometric techniques. But it's not about that. It's about a famous film, a sketch from a famous film from Monty Python, where John Cleese says he's trying to incite a rebellion against the Roman Empire. And he says, what did the Romans ever do for us in an attempt to incite all the people to rise up against the Roman Empire? And then he's suddenly shouted at by all these things that the Romans did. They built aqueducts, they introduced law, et cetera, et cetera. So the title is intended as a gentle provocation to people in this room. But it really is a gentle provocation because, in a sense, it's intended to say that the truth is the monetarists have done a lot for us in terms of central banking. And I think that's something which is actually, back in vogue to some extent. So this is a headline from yesterday's Wall Street Journal. And it says, the current rise in inflation is earning inflation another look. And okay, you don't really have the whole article here. But the tone of this article is, now that the elevated level of inflation is causing a reevaluation, and maybe it's encouraging us to see that some of the issues raised by the monetarists are coming back to the fore. So even though I don't think it's either likely or realistic or desirable that we head back to a world of monetary targetry and so forth, nonetheless, I think the tone of what I'm trying to say is that there is a lot of information we can learn from the experience and academic work that the monetarists have provided. And maybe there is some guidance about how we should think about the monetary policy transmission mechanism, which is missing from the conventional models that seem to run the monetary policy process at the moment. So now coming from the Bank of England, a natural starting point for having this discussion is an article written by the former governor of the Bank of England and now Lord King, so Mervyn King, which was published in the bank's quarterly bulletin almost exactly 20 years ago this month, which had the title, "No Money, No Inflation, the Role of Money in the Economy." And that article was an attempt to sort of reconcile an apparent contradiction that was emerging at that point. On the one hand, it seemed like monetary policy makers had embraced the famous dictum of the arch monetarist Milton Friedman that inflation is always and everywhere a monetary phenomenon. So we saw a shift in the way monetary policy was operated through the 1980s towards assigning responsibility to independent central banks that had the goal of price stability in some form, and that seemed to be working well. It's better than we had seen in previous monetary policy regimes. We talked last night at some point about the Great Moderation. So this speech, this article written by Mervyn King, this was at the kind of peak of the Great Moderation. And as Lucrezia said last night, there's always this question about, was that Great Moderation to do with good luck or good policy? She contributed to that literature. And predictably enough, the central bankers thought a large part of it was due to good policy. So, this was the triumph of monetary policy. This was the triumph of, but at the same time, and this is on the other side of the paradox, it was a period where when people were describing economic developments and even describing how monetary policy worked, money or monetary quantities were given less and less role. And of course, you can explain that, and this is an explanation which is perhaps read more through a British lens than a continental European lens, but you can explain that on the back of the poor experience with intermediate monetary targetry, broad money targets in the 1980s, which essentially said, as you tried to control broad money in an attempt to influence the macroeconomic variables, notably price developments and inflation, that have historically had a stable relationship with that broad money aggregate, then the stability of the relationship came under question. And that was an expression of Goodhart's law. That's Charles Goodhart. And I think part of the story may be some expression of the literal as maybe people had originally thought, but partly it was an expression of changes in the financial sector and the introduction of new instruments and so forth and so on. So how did Mervyn try and reconcile these two things or address this apparent contradiction? I mean, I can't really give true representation of the quality and breadth and depth of the arguments he offered. But at sort of high level, a key part of his argument stems from what Bill Poole famously said in the late 1960s. And that was basically an assertion that shocks to money demand in modern financial systems, especially at very high frequencies, are very big and very difficult to predict. So if you're trying to control the nominal dynamics in the economy through controlling money, because money is such a noisy series, you end up with a lot of noise in the system. Maybe better to focus on controlling the short-term interest rate and putting money somehow into the background. And of course, it's that thinking that underlies the sort of typical canonical model of monetary policy, which is expressed in these three equations: the new Keynesian Phillips curve, the new Keynesian IS curve, and the closing of the model with a Taylor-like interest rate rule. There is no place for money in this model in terms of the formal expression, but essentially the argumentation made in Mervyn's article was money is still here, it's still crucial, but it's just running in the background because of the pragmatic decision to use an interest rate rule and use interest rates as the operating mechanism for the operational tool of monetary policy, rather than using a measure of the money base or a broader measure of money. And of course, that model has led to the explosion of a massive literature, a whole cottage industry of people undertaking analyses of different interest rate rules. That's somehow both codified in and catalyzed by the magnum opus of Michael Woodford, which is called Interest and Prices, and sort of summed up the core of the new monetary policy consensus over the last couple of decades. But I just wanted to kind of contrast that magnum opus with the one from the 1950s and 60s, Patinkin's, and that was the same type of book, but it was called Money, Interest and Prices. So, the advance over this period was somehow money had dropped out of the system, at least explicitly, although I think Mervyn's argument was a little bit that it was still there in the background. Now, I think, what I would also say is that that story is a story that says maybe it doesn't matter so much whether you're looking at money or interest rates if you're in a world where one is just an alternative representation of the other. That's the pool story. But I think what it leaves open, and this was the sort of other question that the King paper sort of raised, is there another channel of transmission which does not operate through the short-term interest rate that you need to somehow capture in some other way, of which money may play a role? And so I think we have to kind of recast the problem as it's not money versus interest rates, it's whether money can add something to interest rates. So, 20 years on, I think there are three questions that I sort of want to broadly, elliptically touch on today. I'm going to focus on one. The first is a sort of backward-looking question. So what have we learned over the last 20 years? What have we learned since Mervyn King wrote this article about the role of money in the economy and money in monetary policy? When I briefly discussed this with Sylvia, unfortunately, because of the embargo, Sylvia has never seen the paper that's just been published in London. So she will have to comment on this paper without having seen it ever, which will be an interesting experience for all of us. But when we discussed this briefly, as soon as I said, well, one question will be, what have we learned over the past 20 years? She immediately said, well, we've had experience with quantitative easing, right? So surely that must tell us something about the role of money or monetary quantities in the economy. You can see here, this is the Bank of England's experience with QE over the last 15, 20 years. Just want to make 2 points before we start in terms of setting expectations. The way it's expressed here is, at the Bank of England, we've really had 5 episodes of quantitative easing since 2009, labeled, predictably, QE1 through QE5. Now, we heard in the last presentation about the detailed econometrics we can do in rich data sets, and microeconometricians are always a bit skeptical of empirical work in macroeconomics because it's, small sample problems and all that. In evaluating QE in the UK, we have 5 observations. That really is a small sample problem. And second, we know that QE has been introduced in response to dislocations in markets, in response to macroeconomic shocks. So the identification problem here is very, very intense too. So if you've got a small sample problem and an identification problem, of course, there's another whole cottage industry in trying to extract quality empirical research out of this evidence, but nonetheless, we have to be somewhat realistic about what we can expect to have extracted from that experience. The second thing I want to say is, over the last 20 years, the financial system, in the spirit of Goodhart's law, has been quite significantly transformed. And that has big implications for how we think about money, and I'll pick those up in a second. But just to highlight here, back in the day of Friedman and Schwartz and traditional monetarism, at the heart of what they were talking about were decisions about substituting money holdings for consumer durables. It was about money and goods, and how easy and under what conditions that type of substitution would take place. Now, that isn't something that's disappeared from the macroeconomic narrative. It's only last year, or about 18 months ago, that a big part of the macroeconomic discussion in the UK was about how the excess savings accumulated during the lockdown period might be spent over the coming few months, the coming year. And there was a concern that that might lead to some sort of consumption boom, excess demand, and drive up inflation. Now, inflation has gone up, but inflation in the UK hasn't gone up because of a big boom in domestic demand, a big boom in consumption. In fact, we're still at levels of activity that are only 0.5 percentage point today above where they were pre-pandemic, and still more than 2.5 percentage points where we would have expected them to be at the time the pandemic started. So there are other causes, or other drivers at least, of inflation in the short term, and we know them: energy prices, et cetera, and so forth, the tightness of the UK labour market coming from some of the negative supply shocks to UK labour supply. So where we have shifted, though, is away. Some of the point I'm trying to say is that's typically been expressed as a discussion around savings behavior, spending behavior, and so forth. But you could express that as there is a monetary overhang because almost all this excess saving was held in the form of bank deposits. And how is that monetary overhang going to be spent? So you might say monetarism still has a sort of angle on that, a view on that. You just choose not to use their language, but it doesn't mean that isn't a part of what the story is. But nonetheless, I think it is important to recognize, and this will follow in what I'm saying later, is that increasingly, and this was a point made by Mervyn King in his speech 20 years ago, increasingly money is playing a role in how transactions take place, not between the financial sector and households and firms, but within the financial sector. So a large part of broad money in the UK is held within the so-called non-bank financial institution sector. That used to be what we call shadow banks. And it's very much a big part of how the portfolios of asset managers like life insurance companies and pension funds work and operate. I mean, we saw in the financial crisis that exposures between banks were at least as important as exposures between banks and households and firms. But as the financial sector has become more complicated through a combination of regulatory changes that have shifted activities into the shadow banking sector and financial innovations that have encouraged the growth of the shadow banking sector, I think increasingly what we're seeing is it's through those institutions that these monetary channels can work. And crucially, because those actors are operating in asset markets, the impact of these money flows is on asset prices rather than on consumer prices. So what I'm going to try and argue today is that if we're trying to think about what we can learn from monetarism and how monetary quantities can matter for transmission, it's going to be working through the financial sector into asset markets, and then it's developments in asset markets that are going to affect the spending, pricing decisions in the household and firm sector. So that's kind of, a part of the past. I'm going to spend a little bit of time on that, but not too much. Where I'm going to spend most of the time is on talking about how we think about these issues in challenges of the present. And here what I'm going to sort of focus on is how we should think about the challenge of quantitative tightening. So the situation in the UK is a little bit different from the situation here in the euro area. We stopped buying more assets at the end of last year. We started raising interest rates in February. We started shrinking our portfolio of assets accumulated through QE, which are almost overwhelmingly gilts or British government bonds. We started running down that portfolio by saying we weren't going to reinvest maturing assets as of February. And indeed, we have seen some maturities and the portfolio has shrunk. And at present, we are considering whether we will move to selling assets. So the MPC has announced that the staff is going to make some preparations on that grounds. I don't want to preempt the conclusion of those preparations and discussions, so you shouldn't read anything to what I'm saying as a suggestion we're definitely going to go down that road. But what I think you can take away from what I'm saying is I'm trying to articulate this sort of framework, how we're thinking about those types of questions. And the specifics of those types of questions include, like, can we run down the asset portfolio and change interest rates at the same time? What should be the relative weight of those two in the quite the overall tightening we want to take with monetary policy, and how should we conduct one in parallel with the other. And then the final thing, which I won't say too much about, is just to pick up on whether even after 20 years, there are still some things that Mervyn King identified that we have to think about for the future. In his article, Mervyn King basically identified 3 concerns or fears he had for the future because money was no longer explicitly part of the monetary policy framework. Now, I'm reordering a little bit, but one of those was, well, maybe we won't think enough about these portfolio channels through which money can operate, which may be important for monetary policy transmission. I think it turns out, because of QE and so forth, we've been forced to think about that. And in fact, there's a whole other cottage industry in that interest rate world, in that canonical model world, introducing financial frictions and exploring their impact. That's such a big literature, it's hard to summarize. It's not a literature that I think gives much empirical bite to monetary policy yet, but it does influence, I think, some of the ways we think about these things. But the other 2 fears or concerns that Mervyn King expressed, I think, are ones that we should probably still be thinking about, and I don't have strong solutions to those. The first is that maybe ignoring money leads you to move away from recognition of the famous classical dichotomy, which says that we need to be focused on price stability with our nominal tools and not get distracted by the possibility that we can smooth output. And associated with this, and this was his other concern, was that to the extent you get distracted away from your core business of maintaining a nominal setup which is stable, then maybe you end up being forced into fine-tuning or attempting to fine-tune developments in the real side cyclical behavior of the economy, and that again is a distraction from core business. And I think both of those things a little bit reflect discussions that came out last night on the back of Stephanie Schmidt-Grower's presentation. I mean, as the questions of both Volker and Lucrezia revealed, I mean, perhaps the core issue here is, in the face of heightened levels of inflation, how can we ensure we have the regime that keeps inflation and inflation expectations anchored close to target? And maybe, as in fact Volker was suggesting, something in the monetary framework, something in the how money is created and managed, so the gold standard he was talking of, but that could apply more widely, that is something which provides a kind of nominal anchor to the system and keeps us in the right regime. Okay, so I mean, I just want to just touch on this. In the written version of these remarks, which will now be on the Bank of England's website, I talk about a lot of things in more detail, but in the interest of time, here are what I define as the sort of 5 main tenets of monetarism: a focus on price stability, a preference for rules over discretion, which I think takes concrete form in central bank independence, a medium-term orientation, and having some nominal framework, be it expressed as an inflation target or some other nominal target in the system. Those 4, I would say, have become mainstream. So maybe they were monetarist originally, but they're essentially now features of any reputable monetary policy strategy. So even though they were controversial, or some of them were controversial at some times, I think they've become conventional wisdom. So, you can talk about, as we used to do back in the day, the ECB's monetary policy strategy being rule-based, but not rule-bound. And the Bank of England can talk about its flexible inflation targeting strategy as being an expression of constrained discretion. But, back in the day, we discussed a lot how those things were different, but maybe by discussing how different they were, we missed the fact that, in fact, there was a lot of convergence, maybe from opposite sides, on a common, pragmatic, but systematic approach to using monetary policy to try and achieve and maintain price stability. Where there has been less convergence on monetarist ideas, maybe less convergence in general, but to the extent there has been convergence, it's been away from monetarist ideals rather than towards them, has been in applying some sort of central role to monetary quantities in the design, conduct, transmission, and communication of monetary policy. And I think, this seems to run a little bit at odds, though, as I said, with what we've seen with quantitative easing. So here's how the Bank of England communicated its quantitative easing program back in March 2020, but similar language was used on other occasions. And for all the talk about pool, all the talk about the framework that Michael Woodford has developed with the focus on interest rate, when push comes to shove, and you're doing quantitative easing because you're at the effective lower bound of nominal interest rates, you nonetheless express how you're doing it in a quantitative terms with a focus on the stock of QE, the stock of asset purchases financed by the creation of central bank reserves. So this does seem to be a way in which quantities are being brought back into the system, although if you look at what's going on in Japan with yield curve control and so forth and so on, maybe, in fact, this was the acme of focusing on quantities, and there seems to be some move in the other way again now. So that, I think, is open for debate. So there is a big literature on trying to assess the impact of quantitative easing. Some colleagues at the bank have recently published a summary of some of that literature, at least the contributions conducted at the bank, and that builds on a number of previous summaries in the past. That is discussed at some length in the written version of these remarks, but I'm not going to get into it here. But one thing I will say is that what my colleagues do is they identify a number of different channels by which QE influences asset prices, a signaling channel, so QE tells you something about future interest rates, a liquidity channel, you add liquidity and that makes markets work better, and crucially a portfolio balance channel. And the kind of point I briefly want to make is this portfolio balance channel, it just sounds like a monetarist channel of transmission. So if you go back to the way Brunner and Meltzer talked about the role of money in monetary policy transmission back in the day, what they said was, if we inject more money into the system, what happens is we force people to bid up the price of assets, squeezing the yields, the spreads, the risk premia, the term premia that are not captured in the risk-free curve or the policy rate, and yet are very important in terms of determining the borrowing, spending, and pricing decisions of firms and households. So the way they kind of characterized money in their monetarist framework was, yes, we need to see the interest rate rules and all that sort of stuff, but we need money too, because the quantity of money is a way of causing, but also summarizing the impact of all these movements in spreads and yields. And I think one expression of that was in the Bernanke and Blinder model of the bank lending channel, where they focused in particular on how this injection of money would lead to changes in spreads and so forth on bank balance sheets. And there is a sort of parallel between these 2 points because the pricing of loans and the covenants applied to loans, this is largely proprietary or private or confidential information. So if you want to find out those channels of transmission, which may be important in some circumstances, you need to look indirectly. Now we do have credit condition surveys, we have senior loan officer surveys, so there are attempts now to try and get into the weeds there. But I think there's still a case for saying, in the big picture, looking at money can have that effect. But just to go back to what I was saying earlier, is that the structure of the financial system is changing pretty rapidly. And banks are becoming much less important in terms of the transmission, and we're getting more transmission via non-bank financial institutions through asset markets. And crucially, those asset markets are typically much more transparent. So non-bank financial institutions like life assurance companies and pension funds, they are trading on open markets where you can see the price on Bloomberg. So my point is that using money in the way Brunner and Meltzer described was an attempt to summarize some information that was unobservable, whereas now we can largely observe that information. This is still the same portfolio balance monetarist channel, but it operates in a way that you don't, again, need to look at money directly. Money is still importantly there, but you can observe the consequences of the monetary injections and the monetary quantities expressed in the asset prices that result from them. And those are the things that then feed through into the way households and firms behave. So, here's the usual event study type exercise, which has been used to try and measure the impact of QE. So, we can talk here about two different yield curves. There are announcements of QE by the Bank of England. There's always the question about how much was anticipated, how much was a surprise, because these event studies ought to reflect the impact of surprises. And we can see how different maturity interest rates responded to these liquidity injections. This is in 2009. This is in, well, they're both in 2009. And you can see, there are relatively significant effects. These are in gilt yields, say, out to 10 or 15 years. We see effects of about 30 basis points. But I think these kind of event studies are a little bit the empirical analog to the famous words of Ben Bernanke when he said, the problem with QE is that it works in practice, but it doesn't work in theory. In other words, these types of pictures can tell you, yes, when we did QE, we did see yields lower, so we know there was some easing of financial conditions that was supportive for the economy. But if we're trying to understand what is the way this is working in its entirety, and understand what the risks and other channels of transmission are, we need a more structural version of how QE works. We can't just rely on these very reduced form event studies. And that sort of turns the remarks of Ben Bernanke the other way around, is that until we have a view of how it works in theory, it's difficult to know how we can use it and calibrate it to work in practice, except in very extreme circumstances when we need to address an emergency situation. So I'm just going to sketch out, to conclude, a very simple stylized model of how we think about these asset purchases and sales, and try and express it how that feeds into the way we're thinking about QT, about the selling bonds and reducing the asset portfolio at the Bank of England. So, I think we skewed earlier that it wasn't an occasion for algebra, so this is certainly not an occasion for algebra. But I just want to so this is an extremely simple stylized model, right? So there's no empirical implications of this. And you shouldn't think of this as me giving any signal about, the likely quantities involved. So I'm just literally drawing pictures here, just so you know. That was more addressed to people outside this room than people in this room. So, we just got three equations. The first equation just defines the balance sheet or portfolio of what are these non-bank financial institutions, so they hold money and bonds. And the crucial thing is bonds are risky because their price goes up and down, but money is capital certain and liquid. So you often hear in the literature now a discussion of safe assets. Well, what are safe assets? There was a little bit of that earlier on today, but maybe safe assets are liquid, capital certain assets, and that sounds a lot like monetary assets. So again, it sort of seems like we're reluctant to put the label money on things, even though that's really what we're talking about. Anyway, so that's the balance sheet. Then we have the standard money demand equation, where money holdings depend on the size of the portfolio and relative rates of return. And then we just express the bond holdings here, the return on bonds, reflecting the fact that they have not just a coupon component, but also capital gains and capital losses. Now, the simple story here is if you take money out, that means, relatively speaking, you have to hold more bonds, and that means the return on bonds must go up, and that means the yield must go up. So that's just the traditional simple portfolio balance story. But the subtlety here, to the extent there is one, and it's not a very original point, is that this forward-looking element of the capital gain means that we have to think about how portfolio managers behave in a forward-looking way. So how does that play out? We can get some difference equations and so forth and so on. This is not the place for this type. But what it leads to is if you introduce a removal of money from the economy, then you know that when that takes place, the price of bonds has to fall in order to create the expectation of a capital gain that is going to be required, such that people are prepared to hold more bonds in equilibrium after the money is withdrawn. But what's kind of interesting here is in the meantime, in the run-up to actually withdrawing the bonds, if you announce that you're going to do so before, Well, what you have to do is then, the fall in the price of bonds means that money has gone up as a proportion of the portfolio. And so in order to get people to hold more money up until the money's actually taken out, so between the announcement of the quantitative tightening and the implementation of the quantitative tightening, you have to introduce a rise in the bond price such that you get the expected fall, which generates the capital loss that allows you to hold a bond. And that's a version of the Dornbusch overshooting story, except in this framework, and as a consequence of this equation, what it induces is undershooting, right? So if you're going to implement your QT here, you know that at that point, prices have to fall in this amount in order to induce the expectation of a return, positive return going forward. But at the time you announce the QT, you have to have a smaller fall such that you can get this expectation of capital gains up until you get to the point where the actual QT implementation takes place. So it's the effect measured in those event studies is only part of the overall impact that you get in the end. And I think that's one thing I'd say is that in order to kind of get that conclusion, of course that conclusion depends on the model, and the model may be wrong, but you need to have this structural view of what's going on. You can't just rely on the event study. So that has a kind of number of implications of things that I think are interesting. So I've spent my time during this period of QE, both in central banks and in financial markets, as was said. My experience is that, as was reflected in the Bank of England communication, central bankers tend to emphasize the importance of stocks and the importance of announcement effects in terms of how market pricing responds to asset purchases or asset sales. And so that's the stock effect here. We do see a stock effect, but the stock effect isn't the whole story. Whereas financial market participants tend to emphasize the flow effect. In other words, the impact when things are actually bought and sold rather than when they're announced. And you can sort of see there is a flow effect too. In fact, you could argue there's sort of a flow effect going through here. So it's not that they're both right in some sense, but neither of them have the whole story. And again, that's something that you wouldn't be able to say unless you had some sort of structural model involving money and not just looking directly at the prices. Even though the impact of this policy does work its way through prices rather than quantities when it comes to its impact on households and firms. The other thing I want to say before concluding is that a lot of the studies summarizing work at the Bank of England have emphasized that quantitative easing, and by implication also quantitative tightening, is state contingent. So it works to different degrees of magnitude depending on the environment in which it's implemented. And in particular, how well markets are operating, or how badly markets are operating, is an important determinant of the potency of QE or QT. So in this kind of simple framework, you might think about how substitutable bonds and money are as a measure of how well markets are functioning. So that's the sort of substitutability parameter in this model. And, punchline, which I'll show you in the picture in a minute, is if you have better market conditions, it's easier to substitute between bonds and money, so you need less of a fall in the bond price in order to get people prepared to hold the more bonds that you need. And so in good market conditions, QE or QT is less potent than in bad market conditions. But there is a subtlety here, which is you also need less a difference in the run-up in this period between the announcement and the implementation in order to get people to hold that additional money as a share they need to hold once the pricing of the bonds is in. So in bad market conditions, you get a much bigger fall in bond prices, a much bigger overall increase in yields. But when you have the better functioning markets, you get a smaller overall effect, but you get more of it up front. So I think that's kind of a little subtlety here is, yes, there is state contingency. It is true that the better markets are functioning, the more easy, the less the effect of QE and QT. But it's also true that you get more of the overall effect up front in relative terms than you do when markets are more dysfunctional. So what are the implications of all this? And then I'll just briefly conclude with a few policy reflections. First, key thing is, in this, QT is a quantity, monetary quantity story, so it's monetarist in that sense. But crucially, in the way it is done now, in a context of the type of capital markets we have now, it operates largely through asset prices. So if we can observe asset prices, that may be sufficient. We don't need to observe the monetary quantities in order to understand the impact on households and firms. We know that asset prices will price in the effect of QT on announcement, or at least part of the overall effect of QT on announcement. So there are benefits of being predictable, so that pricing in takes place in an efficient way. There's no benefit to try and obscure what we're doing, because then we will just introduce noise into the system. This undershooting story I've emphasized suggests that there are some benefits of being gradual, for stretching out the period between announcing and implementation, such that you get this smoother decline in bond prices, or if you like, a smoother rise in real interest rates, or real returns on bonds, real yields, which may be easier for markets to adjust to. And then in benign market conditions, the impact of QT on asset prices will be smaller, right? So that's the state contingency point, although there is this small caveat I mentioned. So if you look at the MPC's communication on QE and QT thus far, it really has two elements. The first paragraph, which was published in August 2021, this is before I joined the ECB, sorry, the MPC, the bank basically picked up these arguments. So what I've been describing is a sort of rationalization of the public view of the MPC. And so basically the view of the MPC is that if you do the reduction in the asset portfolio, you undertake the asset sales, or you run down the portfolio in a gradual and predictable way when markets are functioning normally, you wouldn't expect it to have a symmetric effect relative to the quantitative easing, the purchases of assets that took place where those things were not true. And I think what this allows you to do, and this is perhaps the punchline, is it allows you to implement in practice, well, another thing the MPC has said, which is that even though you may be conducting part of your tightening via shrinking the balance sheet through undertaking asset sales, you can still use bank rate as the active instrument of monetary policy. Now, what I mean by that is that you want to have your asset purchases running in the background. You don't want to have policymakers discuss on a month-to-month basis, should we run asset prices faster or slower? You don't want to have them doing that in response to market conditions or political pressures, as maybe we've heard in the last few days. What you want to do is have that on a sort of slow-moving path in the background, such that markets can price all of these things in. And then the Monetary Policy Committee, on a meeting-to-meeting basis, can focus on assessing the news, the usual macroeconomic data, but it can also see the impact of the asset purchases as it's expressed in the asset prices, which are observable. And conditional on those two things, it can choose the level of bank rate that it sees as appropriate to pursue its price stability objective. So I think the point here I'm trying to make is that what seems to be the framework you end up with in all of this, on the back of these kind of assumptions, is that you can run these two things in parallel with one another, but from a communication point of view and an effectiveness point of view, you want to make bank rate the marginal instrument of monetary policy and use QT as the intramarginal instrument of tightening that's going on. And so I'll kind of leave it there, but just with two final remarks. The first is to say, everything I've discussed fits within the famous canonical framework in that it says we need something more than R here when we put it in the IS curve, right? We have to have some measure of how these other yields and spreads and so forth are fitting in. In the Brunner-Meltzer world, the monetarist world, that additional thing was money, because money was a summary of a whole set of spreads that we couldn't observe. There are those, including my former boss at Goldman Sachs, who many of you will know, Jan Hatzius, who thinks financial condition indices, which are weighted averages of asset prices basically, they should be the thing that goes in there. I'm less enthusiastic about those things, which is one of the reasons my career at Goldman Sachs wasn't such a great success. But I'm less enthusiastic about those things because I don't think we have a strong structural view of how to set what the weighted average should be, what weights we should put on different things. And so that goes back to the point I'm trying to say is that we need to understand at a structural level the portfolio choices of this key non-bank financial institution sector if we're to understand how monetary quantities impact asset prices and then enter the IS equation. And then finally, what that kind of leaves open is that all of this is about these two. Whereas I think if you think about what Stephanie was saying last night, if you think about the concerns that Mervyn King was talking about the longer-term regime choices being determined by money, maybe what really matters with money, and perhaps is particularly acute in an environment of elevated inflation now, is whether money can be something that helps to pin down forward-looking long-term inflation expectations in the Phillips curve, acting in this nominal anchor way. So I've said nothing about that. And I think that remains a pretty important open question for central bankers. So, conclusion, what did the monetarists do for us? More than most people want to admit. Thank you very much.
Yeah, thank you very much, you, for this great, terrific, and above all, inspiring talk. I have many questions, but before I have to think about still what is the aqueduct that the monetarists built for us. So this is something I need to find out. We are now going to stop the stream. The discussant of the paper is Sylvia Kaufmann from the Study Center Gerzensee in Switzerland, and she has decided not to be streamed. And so then afterwards we can have a general discussion among us. So the first thing is we're now going to stop the stream. I'm going to say goodbye to you all and the rest of the world, so to speak.